Welcome to Talk Tickers, your essential shortcut to understanding what's really happening inside quarterly earnings calls.
We're not just about the headlines. We get into the operational details, the strategic shifts, the stuff that actually matters.
Today, we're doing a deep dive into the Q3 2025 results for Hesai Group, the global leader in LiDAR. And this was a really pivotal quarter for them.
Absolutely. This is the one where they officially shifted to scaled profitability. They actually hit their full year goal a quarter early.
Which sounds like a home run, right? But the market reaction was, well, chaotic to say the least.
Total chaos.
So our mission today is to figure out that contradiction. How does a company post a huge profit beat, massive shipment numbers, and still see its stock get hammered with volume that's 20 times the average?
It's the classic debate, isn't it? Profit quality versus raw scale. They prove they can ship units, and they prove they can make money.
But the market immediately started asking questions about the how.
Exactly. So let's start with that financial snapshot, because it really highlights the disconnect right away.
All right, so looking at the headline numbers, the profit beat was huge. Jack diluted earnings per share came in around 25 cents.
And the consensus was sitting at, what, 11 cents? So more than double, a massive beat.
And if you look at the non-GAAP number, it's even cleaner, somewhere between 28 and 30 cents per share.
And that's the big story. They decisively flipped from a non-GAAP loss a year ago. I mean, this is management's whole strategy playing out. Get the scale first, and the margin will follow.
Okay, but here's the first little crack, the reason for that market hesitation. The top line. Net revenue was about $112 million.
Which is still great growth, right? Up almost 48% year over year.
It is, but it was a slight miss. The street wanted to see something closer to $116 million. And you know how it is with growth stocks. A revenue miss, even a tiny one, can spoil the whole party.
It can, but that small mix, it almost seems insignificant when you look at the shipment data. The scale here is just staggering.
What are the numbers?
They shipped 441,398 total LiDAR units.
Just in one quarter.
In one quarter. That's a 229% increase year over year.
And that's mostly driven by the ADAS segment, the Advanced Driver Assistance Systems for cars. That part surged 193%.
It did, but you cannot ignore what's happening in robotics. That's the real breakout story.
Right, for things like industrial use, logistics.
Exactly. And that segment grew by 1,312%.
1,300%.
1,300. Now, it's from a smaller base, sure, but that kind of growth means they're grabbing huge market share outside of just passenger cars, which is a fantastic diversifier for them.
Okay, so profitability is here. The volume growth is exponential. So why the sell-off? And that brings us to the first big question, the quality of that profit.
This is where we need to get into the weeds a little bit. GAAP versus non-GAAP. Hesai reported a record GAAP net income of around $36 million US.
And that's the number that drove that big EPS beat we talked about.
It is. But if you dig into it, the operational profit wasn't the only thing driving that number. Not even close.
So there was something else in there.
A big something else. Management was very clear about it. The GAAP income was boosted by a one-time gain of about $24 million.
From what?
From selling off an equity investment. It had nothing to do with selling LiDAR. So if you strip that one-off item out, you can see why investors got a little nervous about the cleanliness of the beat.
So the real operational picture is in that non-GAAP number.
Exactly. The non-GAAP operating income was about $15 million. That's a legitimate, impressive turnaround from a loss. But the GAAP headline was definitely inflated.
And this whole profit quality thing ties directly into the biggest headwind they're facing, right? The gross margin compression.
It's the other side of the coin to that incredible volume growth. Their gross margin fell to 42.1% this quarter.
Down from what, almost 48% a year ago? That's a big drop.
It is. And management gave two clear reasons, and both are actually tied to their success.
Okay, so what's the first one?
The first is that some high margin revenue rolled off. It's called NRE, or non-recurring engineering.
Right, that's basically service revenue, isn't it? Like custom development for the car companies.
Precisely. It's the high margin work you do up front to get your LiDAR designed into a new car platform. Once that car goes into mass production, that service revenue just goes away.
And then you're just selling the hardware, which brings us to the second reason.
The volume success story. The product mix shifted heavily toward their high-volume ADS units, especially the ATX model.
Which is a great product, but it sells for a much lower price.
A much lower average selling price, or ASP. The word on the street is it's priced around $200 a unit, and that's before volume discounts. So when you shift from, say, 80% margin service revenue to a 40% margin hardware.
Your overall margin is going to take a hit. It's the inevitable consequence of scaling up.
The market is basically asking, okay, you can ship the units, but what does the margin look like for the long run?
But you have to balance that against the efficiency story, which is actually really impressive.
It is. This is the positive counter-narrative. Even with that huge surge in volume, they actually managed to cut operating expenses.
R&D, G&A, sales and marketing, all of them were down year over year.
And they said it's because they're embedding AI everywhere. In manufacturing, quality control, admin. It's showing real operational leverage. They're growing the top line while shrinking the cost base. That's disciplined.
And before we move on, we have to mention the balance sheet. They are sitting on a mountain of cash.
Over $1.04 billion in cash and short-term investments.
Mostly from that big Hong Kong dual listing they did back in September, right?
That's right. It brought in over $600 million. So they have a huge war chest. They can fund R&D and expansion for years without having to go back to the market.
Okay, so let's pivot to the future. The strategic wins and the forward guidance, because this is where the long-term bull case really comes alive.
And they delivered. They raised guidance across the board. For Q4, they're guiding revenue to between $140 and $169 million.
So that's year-over-year growth of what? Somewhere between 39 and 67%? Strong acceleration.
Very strong. And they raised the full-year GAAP net income guidance to between $49 and $63 million.
But the number that really got analysts talking was their forecast for 2026. This is where you see the long-term scale.
Oh, absolutely. Management is now guiding for ADAS LiDAR shipments of at least 2 to 3 million units in 2026.
2 to 3 million? I mean, for the whole industry, that's a game-changing number.
It's transformative. And they said that could even be on the low end, depending on how fast Level 3 economy gets adopted.
And it seems like the regulators in China are pushing that forward.
They are. The conditional approval for L3 vehicle production is forcing the big Chinese automakers to future-proof their cars now. They have to put the hardware in today for the features of tomorrow.
And what's really interesting is how L3 changes the amount of money they can make per car.
Right, because L3 isn't about just one LiDAR anymore. For safety and redundancy, you need a whole system. We're talking 3 to 6 LiDARs per vehicle.
So even if the price of one unit comes down, the total value they're selling into each car goes way up.
Way up. Management thinks the total system value per car could be between $500 and $1,000 for these L3 programs. That's how you backfill that margin compression.
And they're locking these deals in. Let's talk about Li Auto. That's a huge win.
It's more than a win. It's an exclusive design win. For their entire next generation platform, the L, the I, the mega models, all of them will have Hesai LiDAR.
That's a massive moat. Li Auto is a giant, and locking them in exclusively guarantees a multi-year fire hose of volume. It protects their market share.
And it's not just them. They also secured a big combination win with another top 3 domestic EV maker.
And the robotics deals just keep getting bigger. Fleets like Pony.ai and JD Logistics are using up to 8 LiDARs per vehicle now.
Which is just a huge proof point for the entire autonomous industry. These aren't test vehicles anymore. They're scaled operations.
Okay, one last thing on the tech before we get to the stock action. Management talked about competitors, specifically those using a different tech called SPRED.
Single photon avalanche diodes, yeah.
So for those of us who aren't engineers, why are rivals pushing SBT and why is Hesai being so cautious?
Well, the appeal of SBE is its incredibly high sensitivity. So in theory, you can see things farther away. It looks great on a spec sheet.
But Hesai's management basically said that for automotive-grade products, they think it's still too risky.
What's the risk they see?
Increased noise and false triggers. If your sensor is too sensitive, it can pick up stray reflections, things that aren't really there, phantom readings.
Exactly. And in a safety-critical system, you just can't have that. Hesai's position is that proven reliability has to come before chasing the absolute latest component tech.
That's a key differentiator. All right, let's tackle the elephant in the room, the stock volatility. If everything looks so good long-term, why did the stock get crushed?
The price action was just violent. The stock gapped up pre-market to around 24.25. Everyone loved the profit beat.
And then what happened?
By the end of the day, it closed at 20.78, a drop of almost 10% from the previous close.
And the volume was insane, about 7.9 million shares traded.
Which is 20 times their average daily volume. That's not a few retail traders selling. That's big money. That's institutions repositioning.
And you have to remember the context. The stock had an incredible run over the past year.
So this feels like classic profit taking. Traders who were sitting on big gains just used the margin compression and the one-time gain as an excuse to sell. It wasn't really a rejection of the long-term story.
It's a real split in sentiment then. The short-term market is obsessed with margins and earnings quality.
But the sell-side analysts, the ones looking out a few years, are still incredibly bullish. Their price targets are all clustered around $31 or $32.
Based on what?
Based on the structural story. The market share, the Li Auto deal, and that 2 to 3 million unit target for 2026. There's a huge gap between where the stock is trading and where the long-term valuation sits.
Which brings us to our favorite segment for those who enjoy a good thought experiment.
This is not financial advice.
The thesis here is built on that exact gap we just talked about. The market is punishing the stock for short-term noise,
while completely ignoring the secured multi-million unit pipeline that's already locked in.
So if you believe that management will hit that 2026 guidance, then the current price is a major disconnect.
The play would be a leveraged long position, something that gets you exposure to that 2026 inflection point without having to sweat the day-to-day margin debates.
So the trade idea is speculative but logical. A deep out-of-the-money call option. Let's say a $30 strike that expires in Q4 of 2026.
The rationale is pretty clean. You use today's depressed stock price and high volatility to buy a cheap, long-dated option.
So your upfront cost is low.
Very low. And you're just making one bet that by the end of 2026, the revenue and profit from shipping 2 to 3 million LiDARs will force the market to re-rate the stock, likely into that $30 analyst range.
It's a pure bet on execution and the long-term trend of L3 adoption winning out over short-term margin worries. Again, very speculative.
Okay, so to wrap this all up, despite all the market turbulence, Q3 was a landmark quarter. It marks Hesai's official shift to scaled operational profitability.
And they're backed by over $1 billion in cash and these huge multi-year design wins that basically secure their future for the next few years.
They are perfectly positioned for this next phase, which is all about the mass adoption of L3 autonomy and hitting that 2 to 3 million unit target in 2026.
And we'll leave you with one final thought, something management brought up on the call. They quoted this idea that eventually anything that moves will be autonomous.
And the CEO talked about how a fully autonomous L4 vehicle, like a robotaxi, could be 10 times more valuable in terms of utilization than a regular car.
So here's the question to mull over. If the value of the vehicle itself goes up by 10 times because of autonomy,
how does that change what a fleet operator is willing to pay for the critical sensors, like LiDAR, that make it all possible? Does a $1,000 LiDAR system suddenly seem cheap if it unlocks hundreds of thousands of dollars in new value?
That's the big long-term question for this entire industry. Something to think about. Thank you for joining us for this deep dive.
As always, everything we've discussed today is for informational purposes only. It is not financial advice, and it is certainly not a recommendation to buy or sell any security.
Please do your own research. We'll catch you on the next one.